All right. My name is Akshay Kumar, and today I'm going to be talking to you about blockchain fraud detection. Before we start off, I'd just like to mention my sponsor, Alan Frank from Think New Visions. They focus on AI-first strategic technology, and his guidance has been invaluable for us over the course of this project. Now, start off, there's a saying that, when a man stands in a river, right, he can never stand in the same river twice because that river is not the same river and that man is not the same man. I think this is a perfect analogy for the current state of the blockchain ecosystem. The players and the market and the assets are all changing so fast that no one is ever standing in the same place twice. As we'll talk about soon, there is an extreme need for compliance and regulation in this space. And given that your space itself is so dynamic, you need regulation that is dynamic and powerful as well. All right, so like I had mentioned, growing adoption necessitates growing compliance. According to recent reports, about 7% of the world owns crypto. In fact, an interesting statistic, and this has more to do with the rate at which that market is moving. CoinGecko published a report in Q1 of 2025 that had to do with the current state of the blockchain ecosystem. And what they found in terms of the creation of new tokens, the creation of new assets, they found that the all-time high for daily creation was 71,000 in a single day. Towards the end of the first quarter of 2025, that number came around to 31,000. Now, to put that number in perspective, 31,000 tokens a day, we're talking about approximately 20 a minute. By the time I finish this presentation and sit back down, you're looking at 400 tokens at that rate. This market is moving so fast that it's extremely hard to regulate and extremely hard to track. And given the rapid acceleration and the exponential rate at which this market moves, you will need equally dynamic and equally powerful compliance. Now, let's begin by talking about what a rug pull is. In fact, before we move on to this, let me turn your attention back here to another statistic. According to a sample that was taken out of the Uniswap ecosystem, they found that 97.7% of the tokens that they sampled out of the Uniswap ecosystem showed signs of being fraudulent. Let's say that number again, 97.7. That's almost all. And in fact, someone who is familiar with this market may not even find that all too surprising, given that the graduation rate for tokens is year after year at or under 2%. Most new tokens fail. Now let's talk about the type of fraud. The most common is a rug pull. So let's talk about what a rug pull is. A rug pull is an asset that is created by a group of people, and it proclaims to have some kind of value. Now, the way it attaches itself to value may be attesting some kind of research. Oftentimes, it's very simple. They tie themselves to some celebrity, a game, a movement, a show. It can be anything. But what they do is they create rampant speculation on this product, on this asset, and that asset is bought by investors hoping to seek returns. And then what happens is the creators drop their support, they sell the asset, and they leave everyone else holding the loss. We can see an example of a chart right here where we had an asset. This is DogeX. In fact, we're going to be going more in detail on this specific asset later that saw a rug pull-like situation. We see a rapid increase in price, and then we see a sudden drop as the creators pull their support. Now, this is an extremely large problem, I think, as we can understand. If the vast majority of assets in a marketplace are fraudulent, the ability to detect that fraud and understand that fraud is extremely important. both for the integrity of that market and as its own investment opportunity. So here I'm going to be going over our solution at a very high level. Now, before we get into this, I would like to say, if you want to discuss this in more detail with me, some of the specific mathematics, the specifics of key things we've noticed during investigations, feel free to come and talk to me during the networking hours. Now, when it comes to solution design, I can go into specifics about hypergraph analysis and specifics about studying volatility curves and stochastic calculus and all of that. But the truth is, under all of the mathematics and all of the data science and all of the programming is a very, very simple philosophy. If it walks like a duck and it quacks like a duck and it looks like a duck, it's probably a duck. What we do, our mathematical models are abstractions of crypto market ecosystems and actual projects and assets. And what we do is we study across assets that are fraudulent and aren't fraudulent, and then we compare what is similar between them and what is not at a very high level. So it's not just a superficial comparison, does one thing look like the other? We are pulling out key characteristics. Now, a little bit about what makes our solution unique for this problem is one, that it is autonomous, end to end. You have the option to do an entire investigation on an asset or a wallet completely autonomously. It will carry out the multi-hop analysis on its own. It will study the asset's price graph on its own. It will do the graph theory. It will do all of that for you and come back with results. This is really powerful because it democratizes the compliance. It allows for retail investors to also be able to run these kinds of investigations as opposed to human teams that require a lot of time, a lot of money, and they require a lot of expertise. This is something the retail trader doesn't have access to. You might have seen on one of the previous slides I mentioned that 17% of Americans with checking accounts have deposited money into a crypto wallet. The retail market for crypto is huge, and this autonomous nature of our solution, I think, opens us up to that market really well. And I would say from there, algorithmic richness and mathematical complexity, we don't just carry out one specific type of analysis. And we don't carry it out on one thing. We look at the asset, we look at the market, and we look at them through different perspectives, through different mathematical lenses. Graph theory, neural networks. There's a large richness to what we do, the kind of analysis we do, and how we compare them to each other. Now, let's talk about some results. Here you can see a very quick example. This is just tokens that I looked at over 1 week. Again, the rate at which these tokens come in and disappear in the market is unbelievable. And here, and the very, very far right, you'll see a risk score. This, in fact, is not our advanced risk score. This is a more simple prototypical measure. But even based off this alone, we were able to get fairly accurate results on which cryptos were going to fail and which were not. The cryptos that are marked in bright or dark red had an extremely high risk. To kind of put this in perspective, anything above 0.3 is generally considered a pretty high risk. The ones in red and dark red are cryptos that we were almost certain were going to be rug pulls. Now, here in this table, every single crypto you're seeing that was marked in dark red or bright red, every single one of them over the course of this week where I was carrying out my analysis went on to get pulled, losing anywhere from 60 to 99.9% of its value. Now, another point I want to make is that, of course, we can discuss the benevolent motivation for this, which is wanting to improve the integrity of the crypto market. But the truth is that knowing what's going to fail is lucrative. If I can have a way of understanding what cryptos are going to fail, that can be a lucrative thing to understand. There's money in knowing what's about to collapse. And there's multiple ways you can capitalize on that. One example is simple shorting. I do simple shorting, I paper traded basically, and I saw that on these cryptos analyzed right here, if you were to short, you would get a return of around 50% in a week. Now again, given the volatility of the crypto market, that's a qualifier that absolutely needs to be put in. A portfolio like this would have very high volatility, but I think given the robustness of our measures, it could be something very interesting to look into from an investment standpoint. Now, let's talk about a sample investigation. We're coming back to that DogeX token I was talking about before. I'm going to give you an example of very, very elementary example of what our investigation can look like. So here, we begin with the DogeX price graph, and we analyze its price history. Now note, very important, my analysis of DogeX was done before it collapsed. This rug pull happened in October of this year. That's when I was studying it. I computed all of my metrics around there. Well, you can't see the laser pointer, but around like where it's green. Before that first tiny drop, that was where I first began analyzing it. And it was there that our price model told us that there's a risk of 0.97. To put that in perspective, the risk model goes from 0 to 1. So 0.97 is extraordinarily high. Now let's talk about some analysis of the actual trading market for DogeX. We create a bubble map, which essentially allows me to just at once visualize who is trading this token, who owns this token, of the people who own this token, who is transacting with who. Now here, in the center of the plot on the top right, we have a wallet that alone, this one wallet, held around 14% of the entire token. This one wallet held 14% of the token. Now, let's analyze these three wallets marked in red. All three of these wallets had existing reports of fraudulent activity in their past. This is something we see on our investigations all the time. The same organization or group runs multiple different frauds and multiple different kinds of frauds. Exploitation, rug pull, it's a mess, really. It's a menagerie of things. And here, all three of these wallets were marked for previous frauds, combining for about 100 reports of fraud. 100. And we, of course, have strong reason to suspect that these wallets are all controlled by the same group or the same individual by analyzing the dates of creation, earliest transactions, things like that. So, what can this allow us to say? Well, if we know who the bad actors are, at least we know their wallets, I can create a database of these bad actors. And I can see what future projects they may be involved in. If I'm analyzing a project, I can check it against this database. And I could even carry out a multi-hop analysis, let's say on the market of another asset, and see if in that analysis I catch anyone from here. And again, sometimes you don't play the cards, you play the man. If I know that there's a wallet that's involved in a serial string of rug pulls, and I know that this wallet is now a majority owner in another token, that is another critical sign of failure. Now, to discuss kind of business model, what this would look like packaging all of this up, because the goal here is to do that. This is a service that this market needs. Now, how do we package up this service? Well, it's dynamic. Of course, one way we can combine things is in an API, right? For analyzing price history graphs, this is fairly straightforward. You can provide the ticker if it's available somewhere like CoinMarketCap. I'll analyze it. If not, you give me the price history data indexed by time. I'll do my analysis. For wallet investigations, it can be slightly more complex, but that can also be turned into an API. And of course, we can provide individual analyses. You come to me with a market situation you may have, an asset you're thinking of investing in, a wallet you may need to investigate, and then I can do the analysis. Now, let's talk about a little bit of market analysis. This mainly comes back to this statistic from before, 7% of the world owns crypto. So the total available market over the entire world is huge. Now, if we just cut that down, whittle it back down to informed investors in the United States. So that can include retail investors, it can include institutional, who are trading these assets and who may want to know more about them. That, I think, brings us to our service addressable market. And of course, assuming a 3 to 5% capture of that market, we can get the service obtainable. And here, we make a fairly modest assumption of ARPU of about $20. The expansion strategy, of course, here is fairly straightforward. Like I said, this market is massive, and there's many, many people that have their interest set on this field. So there's government institutions that would like to do this kind of analysis for compliance reasons. There's investment firms, like we mentioned. Failure is profitable. So there's many, many different people, like we mentioned, retail investors. There's a massive variety in the kinds of customers you can get. Now, plans for additional development, we want to do some more open source intelligence. Nowadays, especially with services like Maltego, if you have a wallet and perhaps some additional information, you can actually get some data on the person behind the wallet. It is possible in some cases, and say for an example, like a compliance investigation, that would be extremely powerful. So more open source intelligence integration is what we're looking to do. Of course, we're always looking to expand into blockchain governance, and we're always looking to expand on our current mathematical model, and there's always more research to do. Now, the big picture, right? Now here, to kind of cut to the chase, right? Crypto is at an interesting point. It is both a large market and an emerging market. Rarely do we see a market that is both large and emerging, growing rapidly. Crypto is already massive, and it's growing exponentially. Now, we have a market that's growing exponentially. Millions more people are going to be buying and trading crypto every single year. And like we mentioned, the vast majority of tokens that are in this market are fraudulent and require investigation. So now, to safely engage with this market that is only going to grow, we need advanced compliance. Again, millions of people exponentially joining a market where 97.7% of assets show indicators of fraud is probably the best compliance software opportunity of the 21st century. Now, some people may question the morality of making money off of fraud in this way, even if it's secondary. And to those people, I would say, go study ethics, not finance. Thank you very much. I've been Akshat Kumar. I'll turn it back to you for questions.
So what are the time lags between when the coins get launched, you capture the data, and the rug pull? Because you're looking at stuff ex post. So new coin comes out tomorrow. How quickly would you know about it, number one, and then can act on it or make an announcement against it?
So again, here it's fascinating. Many of these coins, many rug pulls happen in the span of just an hour or a day. Many happen in just the span of a day. Coin launches in the morning, has a run, and it's down by 7 o'clock in the night, right? So what I do is, honestly, for this, especially given the graduation rate of 2%, I usually am not looking past a 1 week time frame. I'm usually looking within a week, within a day, and I capture the data and I know about the new coin. This you can do through avenues like CoinMarketCap. You can know about upcoming projects as well, just like you can know about projects that have just began. So I look at projects that have just started today or this week, and then I can carry out my analysis on them in the span of an hour and a half. And of course, given that it doesn't collapse in that time, I can then come back to you with the information and my assessment on both the wallets involved in the market and the returns. Any other questions?
The graph analysis looks very much the relations between existing wallets. What prevents someone just creating a new identity and then issuing the token?
So what prevents someone from creating a new identity and issuing the token?
Yeah, so that it doesn't get caught in the graph analysis.
Well, now here's the issue. Okay, you can create a new identity, and then, okay, I have that new identity, and now I'm using that new identity to carry out a rug pull. I don't want to use my old one. Well, here's the issue. You still need to be related to the asset. See, the funny thing here is that we have millions and millions of dollars moving around in a black market where every movement exists publicly on a blockchain. You can create your new wallet and try to use that new wallet to do the rug pull, but I can still analyze the blockchain of the asset to see who the top holders are. You would need to still be a majority holder even with your new wallet. So you would still come under my purview. And again, the people running these kinds of organizations tend to transact between their own wallets, as you can see here. So if they transact with their own wallet, again, I'll catch them in multi-hop. And the moment they're involved with that asset, I'll catch them by studying the blockchain of the asset, which is usually deployed on Ethereum, the Ethereum blockchain. Does that answer your question? Any other questions? That's totally something I'm going to do. Yeah. Yeah, that's something I'm looking into. There's many, many avenues here. But again, of course, like I said, with that 50% return, you do have to qualify that this is very volatile, and we'll need very advanced ways of managing that volatility. Yeah.
Yeah, I guess, you're talking about crypto expanding. I don't really know, I'm familiar with Bitcoin. I don't really know about any of this sort of this sort of smaller projects. I guess, in the long run, like who is benefiting from this whole ecosystem in general where people are launching tokens, 98% of them are worthless, like where, like not to get fundamental about crypto, but like how is that going to continue being a thing? Like who is benefiting from it? Why would people continue to participate? Like I don't really get that part at all.
Again, it's like any other speculative market. It stops being about value from first principles and true value in the real world, and it starts being about how much can I upcharge for this thing that I bought to someone else who thinks it's going to move up. So it's an extremely speculative market. Now, do we want this speculative market of questionable use to continue growing unfettered, unanalyzed, or do we want to quell and perhaps save retail investors from getting burnt in that market? That's what we're here to do. Now, as for this market as a whole, I guess we'll see. All right, run out of time. If you have more questions, feel free to find me during networking. We'll talk then. Thank you very much.